They probably understand a general baseline of what's going on here. They don't need our investor education 101. And so making sure you're understanding who you're marketing to, so you're giving them content that actually is going to be valuable to them. They're going to continue engaging, and they're going to feel like they're very in the loop on where they place their capital is.
Today, I'm talking with Lauren Brychell, the founder of Equity Elevated Consulting. And Lauren uses her background in capital raising to help general partners raise money the right way. But this episode is not just for deal sponsors. It's actually for you, the investor. So stick around. Lauren is going to help pull the curtain back on what's going on behind the scenes with these deals as they're raising money, they're creating their messaging. We're going to cover things to look out for, messaging issues that you should be aware of, red flags, and then just some interesting industry trajectories that we're on. So before we get into it, if you haven't already, hit that subscribe button on YouTube or your podcast app. And we're going to talk about using ChatGPT a bunch of times today in the interview, on using that for due diligence to help you figure out what questions to ask. And if you want to jumpstart on that, go to the description below and download my How to Use ChatGPT for Due Diligence. And with that, let's get into the conversation with Lauren. Okay, Lauren, thanks for being here. I'm excited to have you today because you are going to be giving a pretty different angle on a lot of these topics than most of our other guests. And I think it's going to be really helpful for our listeners. So, Lauren, why don't you start off by introducing yourself, giving us a little bit of your background?
Thanks so much, Jared. Looking forward to speaking with you today. So yes, I'm Lauren Brychell. I founded Equity Elevated Consulting over a year and a half ago. And really all I do is help GPs and people raising capital in the real estate or alternative space figure out how to find more leads, market themselves effectively to the right investor avatars, and then essentially raise more capital. So coming from a capital raising background and a marketing degree, kind of mesh those two worlds together for this new firm that I am running currently.
Okay, great. And now, before our listeners who are investors tune out, I want to say that the angle of today's interview and what Lauren's going to be talking about is what you as the investor needs to know about what these GPs and general partners are doing when they raise money, right? So this is not a how-to class for GPs today. You know, I'm sure they will learn something if they're listening. This is a kind of like pull the curtains back, look behind the scenes of what's going on when you're getting this messaging and these advertisements. And we're going to talk about automation, and you're getting these emails. Like, what does this look like? How should you be interpreting it? And what are you as the investors, what should you be thinking and what should your expectations be? So that's what we're here today. I don't want anyone to zone out already. So I'm excited about it. It'll be very different. So, all right, Lauren, so you have a background in marketing and you have a background in actual capital raising. Is that correct? Tell us a little bit about that journey and how you got to where you're at today.
Yeah, that's correct. So it was kind of an accident in how I got where I am today. Fate, right?
Me too. Yeah, it's funny. Yeah.
So, I got a degree in marketing and entrepreneurship, went and worked for a startup in a totally different industry for a little while, which was a really interesting experience. Quickly decided that wasn't for me. Always had an interest in real estate. Moved out to Colorado and started working for a commercial real estate firm out here in their early days. And so originally hired on for marketing, quickly transitioned to the investor relations side because our co-founder saw something in me that said, hey, you would be great at capital raising. And I was like, sweet, that's awesome. What is that? Like, I had no idea.
Tell me what it is I'm supposed to be doing that you see that I should be good at. Yeah.
Yeah. So he was an awesome mentor to me and really schooled me up on the capital side. And so I was able to take my marketing skills and being scrappy with different ways to find leads and convert them, and running all sorts of cool events and ads and things. And, raised about $75 million myself while I was there. And then the team raised a couple $100 million as well. So it was a really, really enriching experience. And I kind of saw that niche in the market where there was no one with the actual experience having both sides of that kind of investor relations and capital raising piece out there implementing and helping other firms. And so that's kind of when I jumped off.
Okay. No, that's neat. And so it's kind of a personal question. So answer it however you feel most comfortable. But that's a lot of money to raise. That's a lot more than the majority of people. So what was it that led you to say, hey, I actually want to create a business that provides a service to these people, as opposed to, hey, I'm really good at raising money. I should go raise money.
Yeah, it was a tough decision, honestly, because I love the investors. I love the relationship piece of it, but I really also like helping people. And I knew I could bring a lot of value and really change the capital raising game for a lot of these GPs that I'm working with. And
Hmm.
so, knowing that I could add value and also really enjoying that kind of creative building side of the things that I wasn't able to do anymore once we got it all set up and it was just capital raising all the time, it really sparked my interest. And so every day is totally new day with a new challenge, which I really find intriguing.
Okay. Okay. Cool. Um, so so that's what led you to where you are. Equity elevated, correct?
Hmm.
And explain a little bit about like kind of that niche in the market or that gap you saw, and how that. So one, the opportunity for you. That's how you got there. But how does that play into the investor GP relationship and dynamic?
So, kind of, the gap that I saw was that there were a couple masterminds and things out there that would kind of give you a high level, show you what to do, but they weren't
Hmm.
actually helping you on an individualized basis with your specific avatar, implementing it for you. Because a lot of these folks actually doing deals and buying things don't have the time to also run the capital side of the house or the interest or the knowledge on how to get
Hmm.
started. But that's what they need to grow. And so that was one piece of it. And the other piece was, everyone these days talks about how you can just automate capital raising. And yeah, no problem. Just throw out a bunch of automated drip campaigns and put all these interesting things out there and you'll just raise capital. No big deal, which is not really true when you actually go to try that and do it. It's still such a relationship based game. And knowing how to build that relationship and what to say and how what that cadence looks like is something that I really help GPs with because they just don't exactly know. It's kind of a misconception across the board that once you have a new lead come in, you call them one or two times. Okay, they didn't answer. They must not be interested. Well, we found that it really takes 5 to 7 calls plus a couple of emails, and you've really got to nurture them for a longer period of time with more touch points to actually get them to answer or be interested and see that you're still kind of pursuing them a little bit on the front
Yeah.
end. And so that simple shift alone has helped, but that's something that not a lot of people talk about. And so just taking those little tidbits and things that I've learned over the years, and as the capital raising landscape changes, of course, with the economic landscape and investors having some interesting deals over the past couple of years, it's just kind of
That's
shifted
a nice way to
everything.
say it, right?
Yeah, it's just always ever changing, and it's deeper than just automating emails to raise capital. So that's why I kind of
Absolutely.
dive in.
Absolutely. So, yeah. So, like, well, why don't you speak to that? What are you seeing as in maybe the biggest lack on the GP side that investors are craving right now? Like, so for the investors who are new, right? So, a lot of our listeners are totally new to this, so they don't even know what they don't know. What should they be looking for in a good, general partner or sponsor? To make sure that, at some level, there's a whole lot of touch points. We're not covering all the due diligence with you, right? But where's that gap that the investor should be looking to find a good sponsor to work with them, especially maybe for a newer investor?
Yeah, I would give it 3 quick parts. So one would be that true personal touch point. Is someone actually picking up the phone and calling you? Do they actually take time
Hmm.
out of their day because they care about the relationship with you and you're not just another check for them to come into their deal? That'd be the first one. The second one would be kind of the quality of the content and what they're actually putting out to you. Is it actually interesting quality, or is it just a
Yeah.
bunch of marketing fluff from ChatGPT, right? That doesn't really add value, that doesn't really get you excited and tell you who they are and what their story is and why they're doing these deals. So that's the second one. And then a third one would be I would look at how much time they put into the deal in the capital raise from the front end, from the perspective of, is their deal room nice and polished? Do they have all the documents there ready for you to just view as a potential
Hmm.
prospective investor? Are they organized from that first go around? Because if they have put all the time and effort into caring enough to get all their marketing materials together and organize everything so that it's all there for you presented nicely, that's a huge green flag. And so those are the 3 things I would kind of look for if you're sussing out GPs or trying to figure out,
Hmm.
okay, is this a legit thing or not?
So, were you seeing? I don't know. You're working with a variety of investment, like alternative investment businesses, correct? Like, are you focusing on a single specific asset, or are you kind of across the board?
Across the board and into some non-real estate alts as well, which has
Okay.
been fun.
So what are some interesting maybe niches you're seeing or trends, if you feel like you have enough of a view on where a lot of these alternative assets and GPs are moving? Because sometimes what you'll see is you'll see someone who really is an expert in some weird niche that, is just kind of a newer thing. And then sometimes you're going to see people just like follow the herd. So what are you seeing right now when it comes to what investments are getting up and running right now?
Yeah, no, that's a great question. I've kind of seen it across the board, but I have seen a really heavy interest in small business acquisitions, which,
Mm-hmm.
you know, if you are used to investing in real estate, the cash flows from year one in some shape or way, and they're not seeing those kind of deals right now, the next step is potentially small business acquisitions, because in theory,
Mm-hmm.
they could potentially cash flow from year one, right? So a lot of folks who need that cash flow or are only interested in cash flow investments are kind of trending that direction. Other than that, I've seen a lot more oil and gas pop up. And I don't know if it's just, my circle, but I've seen a lot of investments there. 'Cause obviously the tax benefits are pretty interesting and they can be pretty
Yep.
lucrative investments. But I've still been seeing a lot of your traditional things, right? A lot of multifamily investments are still out there, but now they're buying the ones that are bankrupt or distressed, and they're getting great assumable rate debt,
Yep.
and they're getting a really low cost per door. And so investors are still interested in that as long as it's a really solid business plan and a solid operator behind it.
Yeah. Yeah. Now, are you seeing any, and it's, I came in to the investment arena when multifamily was kind of already at its peak, right? I mean, it was already the in thing. Then, and I probably entered in when self-storage was on the upswing, like high upswing, right? So self-storage is basically a mainstream alternative investment. And then it was, was it mobile homes and RV parks kind of loosely together. And those are probably on the upswing. Maybe I'm not sure. I'm not invested in any of them. Do you see any new things? What have you seen that's like, oh, this is another real estate asset class that the mainstream isn't aware of? That, and I'm not saying that it's bad that these new things are coming up, but like sometimes you get in early on the upswing, you're going to be, you're doing multifamily from 2012 to 2018 as opposed to 2020 to 2022. So anything you see that you've, and that would be of interest for people to look out for. Doesn't mean all sponsors are great.
Yes, good point. No, that's a great point. Those mobile home parks and RV parks do seem to be popping up everywhere. That's definitely a trend that I've been seeing that I actually forgot about until you mentioned that. I would say another one that I've seen are those kind of build to rent communities. And I know that's been around, but I feel like it's
Yep.
becoming more and more mainstream and more normal to see with all the other larger alts. So that's
Yep.
one. And then
I have one near me. Yep.
yeah. I've seen all kinds of interesting things recently, like marinas and different, just totally, crazy things out there that are pretty cool. But yeah, nothing that shocking. That's really getting a ton of large scale attention, I would say.
Okay. And so then when it comes to the other alternatives, you said you're seeing, an increased interest, or at least from your perspective of small business acquisitions. So kind of like true private equity, but on a micro scale or retail investor scale.
Yeah, exactly. Like usually it's sub $1 million EBITDA. So small businesses usually pretty localized, but yeah, which is pretty interesting. And I remember hearing about that kind of for the first time in my life back at the Passive Investor event, I think years ago. So yeah.
Yeah. And just for anyone who's not in the business world, EBITDA, you could loosely dumb it down to like the owner's free cash flow. Very loosely. That's not accurate, but without going into the accounting definitions, basically. So I've seen a few that are like hyper niched. I met a guy at an event that I think we were both at, but like he's specifically providing real estate loans to buy properties to like cannabis businesses, if you want to say it politically correct, right? So like it's still real estate. It's technically debt, but it's interesting because it is heavily dependent upon a single niche sector of industry. So, and that's an interesting one because banks don't like that kind of stuff when it's against federal law, but it operates in the States. So,
Yep.
okay, well, that's great. So you are seeing a shift to some degree, and you're also seeing multifamily sticking around strong with deals that function. And I've had some guys on, and I've had those same questions. It's like, hey, like, are you getting good deals? Are you able to find them? And a consensus I've heard from a few people is we might be near the bottom. I'm not saying we're at the bottom, but this might be the time to consider looking back at multifamily again, because I do have friends who are buying stuff and they're basically like the sellers are bringing money to pay off the loan. And so all their investors' equity was wiped out. 25, 30% equity was wiped out. And they're having to pay money to get rid of the loan. So that's an interesting one. Well, let's move into a little bit of like messaging. So when you're talking, that's what you do. You talk to your general partners. Those are your clients.
Mm-hmm.
What does messaging look like? What are you telling them as you're talking with people? And let's start with people you choose to work with. So we're going to give a baseline of these are people that are reputable enough that Lauren feels comfortable, helping them.
Yes.
What are these conversations looking like?
Yeah, no, it's a little bit varied across the board, but generally speaking, the conversations are looking like, okay, we're going to, we've all seen the pretty generic marketing emails, pretty generic monthly and quarterly reports, everything else. We're putting a lot more of a focus on more specifics, more metrics, more of a story, more of a background around everything here, because a lot of folks are a little bit uneasy right now with everything that's going on. And so giving more context and more value and more information to them and being even more transparent than people have been over the last 5+ years is really, really important. And that's where you're going to keep your investors engaged and happy through the ups and downs, right? Obviously, everything's not going perfect every month and every quarter, but keeping them engaged and feeling like they're in the know and like you're not hiding things from them is more important now than ever. And so we're really taking a very proactive focus on, okay, when we're sending out any sort of email, how are we adding value to the investors? Is this email going to mean anything to them? Is it some kind of generic educational term that they don't care about or they already know? Mm-hmm. And part of that too is just understanding who your investor base is and really taking the time to say, okay, all my investors, for example, are small business owners in Texas. They probably understand a general baseline of what's going on here. They don't need our investor education 101. And so making sure you're understanding who you're marketing to, so you're giving them content that actually is going to be valuable to them. They're going to continue engaging and they're going to feel like they're very in the loop on where they place their capital is extra important. So that's where we've been focusing a lot of time and just being a lot more intentional about the words and the stories and the information that we're putting into any piece of content.
Okay. And now is a lot of the stuff you're working with, is it on kind of like the larger investor relationship creation, or are you also playing, your business, is it also playing kind of an integral role in capital raising for like the capital raising messages for specific deals? Are you also helping people with that?
Mm-hmm. Yep, it's both. It's anything from helping with organic marketing and getting leads in the door, nurturing those leads, to hopefully, helping the clients close those leads and then marketing them to them after they're in the deal. So it's full cycle there. Yeah.
Okay. So I was thinking about this before and I was like, okay, well, maybe I can talk about how like Lauren's on the dark side trying to get their money. And that's really not what's happening, right? You're trying to provide a service, help investors decide for themselves what's good for them, right? And you do that by helping a GP properly position what they're offering. But when it comes to like that conversion, what are some of the tactics you've seen, not necessarily that you implement, but that you've seen that investors should be wary of, right? If someone's using a tactic like this to try to get your money, hey, maybe that's at least a yellow flag. What do you see?
Yeah. Anything with the word guarantee in it, obviously. Yeah. Yellow, red flag. I still see that sometimes, when I get a ton of emails from different people, I still see that sometimes. And I'm just like, what the heck? So anything with guarantee, I would not go for. Anything that you just get that feeling that they're really desperate for your capital, I would not go for. On certain, capital stacks where they're doing preferred equity or some kind of odd structure that's not, maybe not odd, but just different than your usual. And they won't tell you where that capital is going or why they're raising that capital. That's a yellow flag for sure. Because, you can make something look really cool and really interesting that's covering up something potentially really bad. And without that honest transparency and language around it, you really don't know quite what you're getting into. So anything that seems out of the norm, maybe it's not, but just dive into a little further. Those are the couple I've seen recently.
Okay. Yeah. And if you're new and you don't know what the norm is, go check out my guide on how to use ChatGPT for due diligence. At least that'll help you review the PPMs and ask good questions and get you a good starting spot. But yes, I've seen some of those that's like, this is way outside the norm, right?
Yep.
So I want to transition a little bit to maybe I don't know if you have anything sensational, right? But are there businesses that you have chosen not to work with because you're like, hey, I'm not sure I should be helping these people raise money? And I don't want any names, right? But what are some concerns you've seen in the industries you've looked at?
Mhm. Yeah, absolutely. I think, reputation is really important in this game. And as an LP myself, I care really deeply about protecting capital, right? For myself
Hmm.
or anybody else. And so I've absolutely chosen not to work with folks. And just because you've had, one bad deal doesn't mean I'm not going to work with you, right? Or whatever. But if you're consistently having bad deals or just closing on deals for fees, and it's very clear that like maybe this isn't the best opportunity for everyone's capital going into it, it's just not worth it. I mean, there's so many different great deals out there to focus on. Um, and sorry, what was the second part of that question?
Well, and what should we be? And actually, I might ask you this since you just said it. Um, Talk about in GPs doing deals for fees. Like, how does an investor figure that out? How do they see it? Like, because that's something that I know about, and I don't think any of our other interviews we've really touched on. We've talked about fee heavy stuff. We've talked about, but how does an investor figure out if the deal is structured in a way that the GP is making money just to put it together?
Yeah, it's a great question. So, a couple different ways to look into it. Hopefully, the fees are outlined in the offering memorandum to start. Obviously, they're going to be in the PPM, and that's the second place to dive in deeper. But if they're on the offering memorandum and you see that it's extremely fee heavy upfront, and again, it sounds like your ChatGPT probably has some sort of guide on what an
Mhm.
average fee structure should look like. And so, if it seems extremely heavy or the acquisition fees are really, strong, like 5, 6, 7%, whatever that might look like,
Yeah.
that's a red flag. If the fees are coming, whether the investors are getting paid or not, that's a red flag.
Yep.
And so I would, hopefully that information is there in general in the offer memorandum. You're obviously going to need to look at the PPM as well, find
Mhm.
that fee section, and then see the exact schedule breakdown. Okay, who's getting paid when? When does the GP get paid? When does the LP get paid? How are these fees actually paid out? What is that based on? And give
Yep.
yourself a lot more context around that just to see. And I think the biggest just high level things there would be, when are the fees getting paid and what are the fee percentages? And does that seem fair relative to the work they're putting into the deal? Would be my
Yeah.
quick guide for beginners.
No, that's great. And that's one of the things that I think I've talked about, and it should be in the guide is there an alignment in incentives, right? Because if it's really fee heavy, then the incentive is just to put the deal together and not necessarily to run the deal really well.
Mm-hmm.
And on the other hand, I have had investors say, "Hey, I actually don't want to see zero fees because if the deal," and this is me trying to be fair to everybody, and this is an investor, not a GP. If there's if there's no fees before a significant amount of profit and the deal starts to struggle, you don't want the GP to check out because they think there's no way to make money, right? So it does need to be a balance on the incentives. The GP needs to be incentivized to make sure the deal goes well, and they need to really be incentivized if it goes really well. So that
Absolutely.
was something that I learned from a mentor of mine.
Mm-hmm. Yeah, it's a fine balance because to your point, yeah, zero fees are no good. It's expensive to do these deals. It's expensive to have
Yeah,
a really great team operating the deals. And so you want to be able to compensate them to do that. But yeah, I think that's a great
yeah.
point. Alignment of an interest is
You don't want them to take a big fee up front, put the deal in place,
right.
and now all their thought goes into just finding the next deal so they can get another big fee.
Exactly.
Yeah. Okay, that's great. So let's jump back to like what you're seeing wrong. So okay, so you mentioned the fees. It sounds like you are seeing some level of people that, hey, they just always have bad deals. Now we've been through a rough market. So what would you first, before we move into the let's say the less guys you should less consider investing with, the guys who've had a bad deal because the market sucked for a while, right? The market hit a lot of people. What do you tell these general partners about moving forward, right? They just had a deal that either there was a total loss or a significant loss of capital. They have a good deal, and what do you say to them?
Yeah, that's a tough one because their confidence can be so shattered at that time. So really just to rebuild that confidence and say, hey, you know what? A lot of deals don't go to plan. This is why we don't promise anything. This is why our investors understand the risk. This is why we're
Mhm.
super upfront with, hey, you could lose your capital. This is what's going on. This is also why it's really important to communicate very openly and transparently the entire time so that your investors kind of know where you're at and it's not some massive surprise. So
Yeah.
assuming that they're all doing those things well and it's just a bad deal, because those totally happen. There are so many outside factors that can contribute to that. It's really just helping them rebuild their confidence and saying, look, This is a part of investing. Investing is risky. Your investors should understand that, right? They've gotten to
Yep.
this point in life where they're able to invest. They've had to take risks to get there, probably. Their understanding as well, assuming you're being upfront and open and honest and telling them, hey, here's what's going wrong. Here's how we're trying to fix it. We couldn't fix it because of this reason, whatever it is. Your investors will understand. And as long as you've got that relationship with them, they might even come back and invest in the next deal, right?
Yeah.
It's just really focusing on what matters there and not just crushing all your confidence because something just didn't go to plan.
Yeah, and I think I've said this already in another interview, but I had an old sales manager early in my career. So I got a degree in criminology and criminal justice, and then went into marketing and sales. Right. So had an old sales manager said, "Hey, it's not if something goes wrong, it's when it goes wrong and how you handle it that really matters." Now, the scale of what goes wrong can have different degrees of impact, right?
Mm-hmm.
But people will judge you based on how you respond separately from like the actual outcome.
Yep.
And so that's to your point, like you're going to have some GPs who had a bad deal and handled it really well, and they're going to retain, we'll say, some of their investors going forward.
Mm-hmm.
Then you'll have GPs who had a bad deal and they handled it poorly, and they're going to retain 0 of their investors. And then I had Pat Zingarella from Invest Clearly. Have you met Pat?
Uh-huh.
Yeah. So what I like, he was sharing that some of their biggest feedback they see on their site. So investclearly.com, you can go, you can find verified investor reviews where they make sure the person has actually invested with that sponsor before they're allowed to leave a review, right? They actually manually look at it all. But he's saying it's communication. Communication is the biggest thing they see as like destroying trust. And it's not returns didn't turn out exactly like I was promised. It's not like it's supposed to be 30% IRR and it was 15. It's not like, you only did 50% of what you promised. It was, you didn't communicate well. Mm-hmm. Even on deals, he said that went well, communication was still like the biggest issue. And people would say, I would never invest with this person again. Which based on our conversation, that's a lot of what you're helping with is communication. What about the actual, like the people that you shouldn't be investing with? Like, what are you seeing on that side? So separate from just fee heavy, you can have a guy who just getting a little bit greedy, right? But you've probably seen some stuff that's like, this doesn't look correct. This doesn't look real. What have you seen? What are your thoughts? Again, no names, but
for sure,
give me some stories.
For sure. Now, I would say that the things that I see are just crazy, flashy marketing that almost looks too good to be true. It looks too fancy. It looks, I get too good to be true is really kind of that bottom line there. The returns are outsized and you're like, okay, well, how are you going to get there? And they don't really have a great response for it. It's like, oh, well, this is just Corey's deal.
Without not, when I say specific, I don't mean the people or the entities, but what type of investments have you seen where they were like trying to promise these things?
Oh, I saw one recently that was a 5x return over 5 years on a value add deal. Yeah.
Sounds pretty great.
Wow. I was like, interesting. I was like, how in the world? And I think this person, they didn't have a team at all.
Okay.
So, I mean, that's a very obvious one, but I mean, just asking the basic questions of, okay, well, let me see the pro forma on that one. Tell me who's running this thing. Tell me exactly, just simple things like what are the comps on that to add that much value over 5 years. Yeah. So I think just too good to be true, things that look crazy on the return scale. I think some people, especially when they're newer, they don't really understand what the averages should look like or what something that's true should look like. And they think, oh, cool, 5x, I'm definitely going with that one because that's way better than 2x.
Well, that's why doctors and dentists get targeted, right? I've got a buddy who's a dentist and he said, well, if I invest in it, you probably don't want to because it'll probably lose money. And he's joking, but he just knows that he's kind of fallen for some marketing hype over the years.
Yeah. So falling for marketing hype, falling for experience that might have been lied about, I guess, essentially that's a big one too. Yeah. So diving deeper. And then ChatGPT, honestly, is a great one. Like if you don't really know, if you can tell if this person's legit or not that you're looking to invest with, throw their name or their entity or even their PPM. I'd like to do that one too into ChatGPT, and it'll tell you if they've ever been arrested, if they've ever had any lawsuits, anything like that. So that's really
that's part of what I talk about in that guide is after you go through all the PPM and ask about fees and all that's like, hey, ask it to look for like anybody named in the PPM, any entity named in the PPM, anything that's like an affiliated business, And you'll be surprised. Sometimes, I mean, it's just like a news article. But if you didn't know that this other entity was affiliated with the same owner, that would be really hard to find. Like the amount of research that would take. One caveat is that if it's not like on a public site, then it's not, it's not accessible by ChatGPT. If it requires a login, so like if you're trying to look at court records, I think I have a couple of websites in there that like you want to check manually, right? Like federal, like SEC fraud related stuff. That's typically locked behind a login. So, but yes, that's a good one.
Lots of gurus out there these days with pretty marketing that have absolutely no business doing real deals.
Oh yeah. Yeah. Or, they did a few deals and they make a lot of money just selling kind of the idea of what they do.
Yes.
Okay. So you have, and I had a line of thought and I lost it when we started talking about this, but, so you've got people who are falling for flashy stuff. You've got the doctors, the dentists, they're like, hey, they're jumping on, it's not working out well. Are you seeing, I don't know how involved you are in this, but when it comes to the actual PPMs and the offering memorandums, you might help with the OMs, I would assume.
Mm-hmm.
What red flags should these investors be looking for in the paperwork? Because that's one thing that's pretty cut and dry. What are some of the red flags they should be looking for?
Yeah, I mean, a couple of basic ones off the top. Make sure all the entities match up, right, that you're seeing on the other places and paperwork, because that's one that can kind of get sneaky and be hidden in there that if you're not really looking for it. Check out if there's any other owners that you don't see or equity owners that are listed there on either the GP side or in some other investment class that might not have been transparently put anywhere else. Again, make sure all of the waterfalls and split structures that you're supposed to be seeing from the marketing materials are actually outlined correctly in the PPM the way that you expected them to be. Again, any fees that might not have been disclosed elsewhere, because that's the document that's going to run everything. That's the legal doc that's binding all of these deal specifics together. So those would be some off the bat. Make sure the assets obviously match the name of the assets, like just simple things like that I've seen over time. Like, wait a minute, that's not exactly what it said it was over there.
Yeah. Okay. Yeah. And actually, I realized what it was that I wanted to touch on, because we were talking about the way people talk about things in their messaging. I was at a recent conference and I was like, okay, this guy's talking about 24+% cash flow. What does that? And it was micro loans in emerging markets. And so he's talking about these loans that are, I mean, it's essentially small loans in third world countries, right? Helping people buy a phone, this or that. And they're so fee heavy that it might be a 3-week loan, but there's like a 10% origination fee plus the interest. And because if you're getting paid 24% on your money, the annual percentage rate, the APY, has to be higher than that for the person raising the money to make money, right? And so on one hand, I'm just trying to wrap my head, I'm sitting there listening to him and wrapping my head around, okay, can this work at that level? Does it work? And he's talking about how, well, the culture doesn't allow people to not pay back their debts. So there's a really low default rate, but there is a default rate, which means if there's a default rate, that means there's even a higher payment that's being made to account for the default, right?
Yeah. But
what got me on this guy, because I was like, you know what? Like, I've got cash. I could throw in 10 grand and just see how it goes. If I lose it, it's not the most expensive learning experience I've had. And people start asking him questions. So he did his presentation. And that's the one thing I would say is like people's presentations are typically pretty polished. If they're not polished, that could be for multiple different reasons. But don't go for the presentation. But when people start asking questions, how they answer them oftentimes will say a lot.
So true.
And basically it went from here's these great returns, here's how much money you can make, to someone kind of challenging is not even the right word. It was kind of just a regular question. And he said, well, if you don't have a heart for helping these people, you shouldn't invest. I was like, whoa. You're promising me 24% on my money. And you're telling me if my heart is not to help these people, I should not invest. I was like, I'm not giving this guy a dime at this point. And I think that asking those questions, and well, it's part of what a GP has to do, answer the questions, but asking questions will help you get to the heart of that person, maybe. And ask the difficult questions. Like I've gotten better about that over the years. Like I've actually had to ask a guy for his date of birth so I could verify that he actually went to like the Harvard Business School that he said he went to. I was like, man, I'll apologize for it up front, but I'm doing it right now anyways. Anything like that you've seen where it's just like, it's looking maybe, and then someone says something and it just like totally turns it for you?
For sure. Yeah, to your point. I mean, listening to their responses and their tone and the way that they talk about things and their just level of education around the deal that they're pitching. I've seen a lot of people have exactly that pretty polished presentation. People ask the questions that probably aren't like super hard questions, but they're a little bit more in
Yeah.
depth. You can tell that they're knowledgeable folks, and they totally stumble and they don't know. And it's like, well, wait a minute, isn't this your deal? Like, aren't you supposed to be the expert here? So that's
Yeah.
pretty scary when that happens, because I mean, if you're not the expert, then who is the expert, right?
Yeah.
So yeah, I think that's a big one. Just not having answers to simple questions, or not having your data organized when you ask for something. If it takes forever to follow up on a request, it's pretty simple and standard. Like, to your point, if they're not willing to give you that date of birth or anything, and they're not
Yeah.
okay with you doing a background check on them, that's a super big red flag. They should be okay with that, right?
Yeah. Yeah. If you're giving somebody 25, 50, 100 grand, like you should be willing to spend the 35 or $50 to do a background check.
For sure.
Yeah, I've had someone want to do one on me. I'm like, sure, here it is. Whatever you need. And they were trying to find a free way to do it. I was like, just like, we'll pay for it. Just use this system that
Right.
you can request it. We'll cover the expense, but you get it yourself, so you know it's real. You know, I think there's like a for anyone listening, I think it's one of the credit unions, like TransUnion, maybe it's one of the big three, where you can do background checks on people for judgments, liens, stuff like that. You can initiate it, have it sent to them, they fill it out, and then you get the results back. So a lot of those background check systems are they're like subscription based. And so people will avoid paying for subscription for something like that. But that's one that you can just like pay one off. I might try and find it, put it in the show notes, but that's a good one. Any other red flags you're seeing in like the capital raising market right now that investors should be aware of?
I think those are kind of the main ones I've seen. Just, I would take if I'm an investor, I'm going to take the time to verify as much as I possibly can. Pull title reports if you want. Or pull, whatever you can. I know title might not make sense actually at that point because they don't own it yet, but there's a lot of things you can pull to really do a little bit deeper due diligence. Take the time to look at maybe some of their other portfolio, make sure that they actually own what they say they own. So something like that would be helpful. But I think for me, it's kind of the high level, like making sure all the information matches across the board, and staying really far away from super flashy marketing and gurus. Like that's what I've seen. Like people they just lose more money doing that, investing with folks like that, than anywhere else. So that's that's step
okay.
one.
So I've got another one that's kind of an odd question, but let's say, and you might see some of these people, right? Maybe these people should be talking to you. But you get, let's say, a sponsor who like knows their asset class. Like they know the asset class. They can run a business, but like they're not super literate around the rest of the financial arena, right? So maybe they're like, hey, well, I don't know what an IRR is, right? Like when it comes to like the capital side and the structures, what level of concern should people have? Like, is it all like, well, they know the asset, they should be able to run the asset, or if it's the and I've had people say, hey, like, they don't like the using IRR to calculate returns because you could have a larger gross return over a longer period of time. But it's like, well, hey, but IRR is like time value for money, right? So how do you balance someone who like, hey, I think you really know your asset class, but maybe you're not thinking about money the way an investor thinks about money?
Yeah, that's a really great question, but I would say that's a pretty nuanced one as well.
It is.
Because I've seen so many folks who are to your point, so good at doing deals. They've been doing it for 30 years and they've never really raised capital before, or they've only raised from friends and family and they get good returns and their friends and family don't care about the metrics, right? So in that case, I think, okay, I'll kind of give them a pass because they really do have good deals and they truly are super knowledgeable. But for anyone who's been doing deals and maybe, okay, they've done a couple great deals, like cool, sounds good, but they're really trying to grow and scale it. I feel like they should be investing the time into really understanding how an investor thinks to be able to grow and scale that. If their goal is to have a $200 million portfolio, you've got to be an expert in that and understand what your investors are looking for once you exit that friends and family capital arena, because that's when it's really going to matter. And if you're not willing to invest the time into putting all that together and putting a true financial model together and really understanding all of those pieces, that would be a red flag for me.
Okay. Okay.
I mean, education is so easy to find these days as well. I mean, literally go into ChatGPT and ask it like how to calculate your
Yeah.
IRR based on the model you've given it. Like it takes 4 seconds. So I think that would be a little bit of an excuse, especially for folks who, might be a little bit newer to it and they're looking to really grow and scale. But
Yeah.
so
Okay. All right. Speaking of education, I know you're working probably with a variety of GPs, deal sponsors, probably in a variety of legal structures, right? So from the investor's perspective, like I know you'll be able to explain this because of how you communicate way better than half of the asset managers, because a lot of them are super technical or salesy, right? And either one of those is not the best explainer of things. Why don't you cover a couple of like, all right, syndication versus fund versus even like maybe like limited partnership or whatever, that's a syndication to a degree. How does that impact the investor? Like one, like brief overview of each one of those that you're seeing. I think there's kind of a trend moving towards the fund model. You may be seeing that, but how does that impact the investor and why should they care? And how is that going to impact maybe their rights to some degree? I know you're not a legal expert, but what are you seeing?
Yeah, that's a good question. So syndication, usually a single asset or a very small portfolio of assets that is identified up front. So you know exactly the 1 or 2 or 3 assets you're investing in, usually through a limited partner structure, to your point. So you're the passive limited partner, and then there's the general partner who owns the other piece of it and may or may not actually operate it, but that's a different story depending on what kind of fund structure it actually is. So that would be that side. Benefits of that, you kind of know what you're investing in off the bat, right? You know the exact assets in theory, and you can do your own due diligence on those assets, those markets, everything else. The fund is multiple assets, kind of just from what I've seen, generalizing it, but multiple assets. Usually you're going in somewhat blind, but usually you have an idea of, okay, we're going to target this type of asset class, this general size in these general markets. Could be a bunch of markets, could be just a couple. It just depends on the operator, but you've got to put a little bit more trust into the operator at that point to know that they're going to pick things that you like in that fund, because once you're in, and they're going to buy whatever it is they're going to buy. So those are pros and cons. I've seen a lot of investors not like funds because they don't have any, control. And of course they don't have control at all, but they feel like they have control and they can tell exactly what they're investing in. And they tend to like that because being an LP is hard, especially for a lot of folks who are used to having a little bit more of that control, right? So
real estate investors are very used to having control.
Yes, exactly. So I'm actually seeing a little bit of a trend opposite from what you mentioned. From people did the single asset syndications. They said, gosh, this is hard. This is a lot of legal fees. This is a lot of paperwork. We're doing this every time. We're doing a new raise every time. Let's just do a fund. It'll be so much easier. Well, what they figured out, a lot of folks, was that a fund is really hard because you're maybe going to have that fund open for a year, let's call it. It's so hard to create fear of missing out and a deadline and and things for your investors that actually place capital in that. 'Cause they're like, why would I invest now? I can invest 6 months from now and I'll get the same returns, right? So it's really hard to keep that momentum going for a large fund. A lot of investors, to your point, like they like to have control. They don't like the idea of going into something that's somewhat blind. So I have seen a trend over the years where people who had moved to that fund style of,
so you're seeing a swing back
to single asset syndications because it's obviously I'm generalizing this, but it's somewhat easier to raise funds deal by deal because there's a deadline and people have to get in and then it closes and then that's it. And then they can kind of say, yeah, I like that one. No, I don't like that one. And it generally can be easier, even though it doesn't seem like it at the time for the operators. Okay.
Well, no, that's interesting. And I would probably rely on your experience because you're probably on the more front edge of what these trends are than I am. So that's interesting to see because I have, I'm probably on the back end of the wave is what I'm seeing, all the guys who are still doing the fund stuff. And it's like, hey, it's easier for us. It allows us more flexibility. But to your point, it may not necessarily benefit the investor. And the back edge of that for the GP is like, yeah, when there's no scarcity, no deadline, no reason to make a decision, it's really hard to get people to make a decision.
Yes.
Yeah. So
very hard.
Okay, cool. Well, Lauren, this has been super helpful, but what would you have any additional maybe words of wisdom as, investors are stepping into this arena. They're looking at pitch decks. They're looking at OMs. They probably signed up for something somewhere, and now they're getting like 15 emails a day from different syndicators. Like, what's your advice to these investors as they start sifting through?
Yeah, my advice would be just kind of going back to the basics on focus on the relationships you're building with these operators. Because to your point, once you sign up for one, you're going to get them all. So you're going to have a lot of different people coming at you, a lot of different deals to analyze. It can be very overwhelming. I would personally, and this is the way I've done it, is I've invested with people who I feel most comfortable with, who I feel at ease with. When I go to sleep at night, I'm not thinking about whether my money is safe or not, right? I like them. I know they're doing a good job because I've taken the time to really invest into that relationship as well as an investor looking to place capital with someone. And so I think pay attention to that. If there's any red flags, if there's any like gut feelings in your stomach, like, oh, I just don't know about this guy. Like, trust that. Don't move forward. Keep it simple and just really spend the time. Obviously, look at the numbers and everything else and do your due diligence, but focus more time on the people behind the deal. And hopefully that will go well for you. So far, it's so good for me.
Okay, great. Yeah. And there's always going to be another deal. That's really important to remember. It's like, just because of being afraid of losing out on a specific deal should not be a reason to invest in it if you're not comfortable in all the other aspects, right?
Exactly.
Yeah. So, all right. Well, Lauren, tell the listeners, let's say I know that what you do isn't necessarily what a passive investor would be looking for. But if we've got any GPs still on the line and listening, what's the best way to reach out to you, contact you, and kind of see if you can help them help our listeners more?
Sure. Yeah. I'm on at equity-elevated.com or Lauren at equity-elevated.com is my email. I'm also on LinkedIn.
Great. We'll have that in the show notes. Okay, Lauren, I really appreciate you being here and helping us kind of see the backside of this industry, because so often all we're seeing that polished presentation. And so one of my takeaways was that good marketing can't cover for bad communication. So ask a lot of questions, right? If you don't ask questions, you're never gonna dig deeper. You're never gonna make that general partner prove that they actually know what they're doing and they're not just really great at creating a shiny object. So that was a great conversation for me. Hope y'all benefited from it. If you are a deal sponsor looking for some help and you have a good deal and you're a good guy, reach out to Lauren. I'm sure she'd love to talk to you. And if you haven't done it yet, hit that subscribe button. Keep coming back for great content.